Hello and good morning, everyone. Welcome to Almus Market Mornings, your daily dose of financial updates with me, Swaraj. And what an overwhelming week we had last week. And I think the turbulence for the risk management flight does not seem to be ending. The indices all show red, yields moving up along with oil. Currencies as well are moving quite interestingly. JK, what sort of turbulence should we expect going forward?
Good morning. Welcome for this week's volatile sessions. Yes, I think it's one of those rare occasions in the markets when all the asset classes are falling. Like usually when the equities are falling due to risk of sentiment, people get into the safety of bonds or gold. But that is not so right now. Equities are falling. Bonds are also falling. Equities are falling because of fears of recession and higher financing costs, and bonds are falling because yields are rising, and people are holding substantial amount of bonds which are bought at lower yields, and they are cutting those positions. Surprisingly, even gold has not offered the kind of safe haven, route for the investors, as well as the yen, which is completely driven by the yield differential with the US dollar. So it's actually been the asset markets going down and then leading to a story of dollar rising, and dollar rising substantially to 20-year high. 104 was seen in 2002, and that is where the dollar index is right now. One would think that after rising so much, it can probably reverse, but I am unable to see any fundamental drivers which will actually reverse this trend, nor is there any indication technically that this is on the way to reversing its gains, because everything is going in favor of the dollar, and there are on the other hand challenges for other economies like Europe, with all their energy problems. Will have a slowdown in their economy. China economy is already slowing down. Japan is still searching for inflation, and they keep doing the yield curve control through unlimited bond buying purchases. Australia and Canada are actually affected by the slowing down global economy. So that's the atmosphere we are in. In this circumstance, we also had the non-farm payroll report on Friday, when the job creation was substantial and going up still, while the unemployment rate stayed at 3.6%, although it was expected to inch down, and surprisingly, wage inflation was down by 0.1%, where the market was expecting 0.4%. It came at 0.3%. That gives some sort of relief to inflation watchers, and people are on the watch out for more moderating wage inflation, but I don't think one data will do any difference to the market expectations of higher yields. In fact, yields have gone up substantially on Friday again, and the 10-year yield is now at 3.14, and which is not seen for a very long time, and 2-year yield is at 2.8, which has also been the high seen in 2018. Stock markets obviously are taking it on their chin, and particularly the tech sector, which has benefited from low yielding environment, has taken it very badly, and that trend is set to continue in Asia. That has continued, in fact, all the markets, and of course Chinese yuan is driving the other Asian currencies lower as well. And in India, of course, the surprise rate hike by the RBI last week has pushed up the yields to 7.4 plus, and then there is market talk about two events coming up. One is the US CPI as well as the India CPI. US CPI possibly, market forecasts say that it can come down a bit, and that can be a relief for the yield watchers, while Indian inflation is rumored to be very much on the higher side, and probably that's why the RBI took an intermeeting rate move as preemptive move. So the dollar remains strong overall. On the rupee, so far RBI has held the 77 levels very effectively by selling and meeting all the excess demand from the market, but market is not relenting. Market is still buying the dollars even against the INR. I think there has been a resumed selling of equities by the foreigners, and that has added to the oil demand already in the market. And I think RBI will have a job cut out if they want to keep the 77 from not breaking. But from early indications of today's NDF market, it looks like we are already trading above 77. And if allowed to break above 77.10, I think a gradual move towards 77.80 is also not ruled out. Of course, we will have some corrective moves in between, and the US data this week will be very crucial.
All right. So as JK mentioned, equities are falling, bonds are falling, and even gold has not been offering the safe haven route which it has typically offered. So guys, asset markets going down, leading to a story of dollar rising to a 20-year high. Risk management is of course the need of the hour. So guys, ensure you have prudent risk management practices in place. Till then, goodbye. We'll see you all tomorrow.